coming to you, if you look at the core inflation target, which the governor is talking about, it's 4% for excluding precious metals. It seems that the inflation or the price hikes in gold or other precious metals is now over, and the governor is discounting that in that outlook.
Well, from here, definitely the core inflation goes up, and we still don't have a very clear view of the 10% WPI and how much of that will be passed on. Now, the biggest risk from the WPI to the CPI is the fuel prices. My personal feeling is that the government will not be willing to increase pump head prices of petrol and diesel any further at this point in time, which necessarily means that the risk on the fuel side is lower. On the core, the issue is that we in the CPI, the composition of the CPI, we still have the goods related inflation. The weightage is just about 28 to 30%. So I'm not sure whether and the services sector inflation has not really moved up, except for say for example the hotels, restaurants, etc., which the governor clearly mentioned is a fuel-led sort of change that has happened. And therefore, the thing that needs to be watched out is the extent of the pass-through. But even if the pass-through happens, the reflection of that within the goods segment of the headline inflation is likely to be not showing up in a very significant way because of the relatively sort of lower weightage of goods as a whole. So I think there is a catch over here, and my way of looking at it is that there will be more sort of looking through the very carefully through the magnifying glass, whether inflation is getting more generalized and whether inflation expectations are rising. Now, for the last three policies, the surveys that we had seen, the inflation expectations of the household was on the higher side. I'm yet to see the latest survey, what comes out. And if that also shows inflation expectations on the higher side, I think irrespective of the core remaining at the 4% anchor, including or excluding the metal prices, is something that will not be of the most critical consideration at that point in time, and RBI would be hiking rates. But at this point in time, the RBI does not see a pass-through having happened in a very significant way, and second order impact of inflation really missing.
Indranil, the current account deficit has been modest for the first 2 months. We're seeing a surplus coming in there with the liquidity flows or capital flows, which measures which have come in. What is the kind of outlook that you have for current account deficit? And the second question is basically on the GDP upgrade that has come in. Do you think there is more upside to it?
Well, the GDP upgrade, the way I would put it is for the Q1, I anyways had a 7% number. So my problem is more with the second half of the year than with the first half of the year, in the sense that if inflation climbs from here on, and what we see also in the data on the CPI, the rural inflation is higher than the urban inflation. The rural segment is very critical in the sense that if food prices go up, their purchasing power for other discretionary actually goes down, which necessarily means that there is a relative downside in terms of demand that I am looking at if inflation actually climbs from here on, both from the rural and the urban sector. Now, survey-based results out of even Retail Association of India shows the purchasing of most of the white goods actually going on the lower side, including fashion items, which is something that we need to also consider as we look at demand going forward. That's on the GDP, and I think yes, there may be an upside, but it is more a technical upside rather than anything else, in my opinion. On the CAD, yes, the comfort prevails, but as we had been seeing over the last financial year as well as the current financial year, I think the critical worry remains on the capital flows side beyond the measures that the RBI has done. Now, very honestly, if you ask me, I think the measures from the RBI also reflect their worry of the capital flows. And that's exactly the reason why you build in a measure like this, whereby you want to drag in capital flows and preempt the flows that otherwise would have materialized over the whole year. You basically sort of lump it together into one sort of bucket, and that's the scenario. But given the global risks, I think the capital flows from a pure sort of play will actually be on the lower side. And that is also to do with the lower interest differentials between India and US. Shubhadeep did talk about the GSEC yields. The GSEC yields, in my opinion, the long end would be more a function of the fiscal, which we don't think any risk is there in terms of higher GSEC borrowing. Any gap can be met by either T-bills or sort of the additional amount they garner any which ways in any year through the small savings collections. But I see an upside capped at around 7% level. So all these factors will be sort of important for the RBI to look at, and not only the current account comfort, which can go if the West Asia crisis is once again proves to be as volatile as it has done over the last 2 months.
Mr. Pan, thank you so much for so wonderfully summing up the policy action for us. And on that note, Mr. Suvadeep Rakshit, Mr. Indranil Pan, Mr. Sadaf Said, as well as all our panelists who joined us on the show earlier, thank you so much for your insights and for your time.